Welcome to a Q&A session here, September 6th, 2017. This is a live webinar session. So what we'll cover here is your questions, and I'll give you some answers and insights. So if you have those questions, post them down below in the feed on the live session. If you didn't get a chance to attend live and you're watching this as a replay, then make sure you get on the newsletter list so that way you know when the next live session is. With that being said, keep in mind, of course, there's no recommendations to buy, sell, or trade any of these vehicles simply because I don't know your risk tolerance. I don't know when you're watching this, and you need to consult your own personal financial advisor that can look at your own account and your risk levels before trading. But I will share with you some insights to what I see in the marketplace, and that way you can get some own personal insights to see what you want to do in the future. So in either case, taking a look at some of the questions here that we have here, I have Thinkorswim platform. I'll be using TC2000 as my charting platform to show you some insights. I just find that this chart platform is very fast and efficient. TradingView also is a good charting platform, and I use it periodically as well, but I like TC2000 because it's lightning fast, very quick. So that's what I'll be using here in this example. So what we'll do here is kind of go down the list a little bit. I'll start a little bit backwards and jump around depending on putting a few things together. So to start things off, let's take a quick look at the market overall and just some quick insight. If I look at the S&P, the couple of things that I always watch, those of you that have followed me for a while, S&P, NASDAQ Composite, these are the two main ones. I don't really check the Dow Jones. It's not something that I really look at, but NASDAQ Composite, S&P, watch those things. I check the VIX here when you look at market volatility to see how violent the market is bound to move. And if we evaluate these things, so looking at the S&P, we've had a couple of serious down drops in the past or here recently, but they've been getting bought out. And that's what usually has been happening since January or since about the election time. A lot of things are pro-business-like, so they say. It's not always the case, but that's what's being said. So the market always buys into hype. Think of the market as being as gullible as possible. They will buy in anything. They will believe anything. And there's a reason for that, which we'll get into. Really, because if things do work out, well, then it'll continue going higher. But if they don't work out, well, at least you rode the wave up, and then you can just sell it at that point if things aren't going to work out. So that's kind of the simple point. So in general, most of the time, these dips have been bought out. So we still continue on the uptrend. So when we get a couple of panic moments, they still get bought out. The key difference here on the last couple is what I've noticed is we were making a lower highs. And this is a little bit of a little pullback that we've had, but we still did get bought out a little bit on those dips. So you can see this trend line potentially is starting to make its way upward. The problem here, of course, is this key level, and it's a level. It's never a line. So even if I draw a line, it's always a range. It's like 3 to 5 points, depending on a certain stock. It could be 10 to 15 points if it's a larger stock. It's always a range, okay? It's not, your friend doesn't show up at 6:15 .00 p.m. for dinner. It's a range. It's going to be within 3 to 5 minutes, right? So the same thing here. It's going to be, if I draw a line, it's actually a range within that somewhere over here. So anyways, this is a key level of resistance right now in the marketplace. You notice as we got into that, we had a large enough sell-off, and our sell-offs have actually been with volume. The volume is easier to see when you go to the SPY. It's just traded more heavily. So you can take a look right there. And the volume has been rising to the bearish side. Normally, when we get these sell-offs, boom, we get a major bearish bar, and then we get huge bullish bars that come in. In this case, it was just average, okay? So that, little bit of a concern. Not huge, but a little bit of a concern. But the market has had pullbacks. It's still buy the dip kind of market for now until, especially we break that 2,400 range and we start creating more lower highs. So if we start creating more lower highs this way, right there, in that way, then you become more negative. Until then, still things are looking okay. You also want to check the leading companies like Amazon. These are the ones that I trade more heavily. Like Amazon, you watch how they behave, react. You look at Facebook. These are the leading companies. People that trade the leading companies are the ones that usually move the markets a little bit more, usually the hedge fund kind of guys. Same thing with like Apple as well. So as these things start acting weak, and you look at this right here where we basically broke this and managed to hold, broke it again but managed to hold, and it's like a jackhammer. It just keeps pushing, 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 pushing down, and if we break below it, eventually we break through. That's what rolls a market over and can get it into some support levels that are even lower, and that's what pulls usually markets lower. So if this, along with Amazon, along with Facebook, these kinds of stocks start rolling these things over, then the market will go with it as well. So they're the leading companies. So in either case, taking a look at some of these questions. Is the preparation of your option class going well? Yes, I actually am finishing the study guide for the Iron Condor section. So I would say maybe another month. These classes, courses, I've been working on that one for about a year. I'll tell you that much. 70 hours or so plus. Options are complicated, so there's a lot of material there. So let's take a look at some of the other things here and ticker symbols that you've mentioned. So if we take a look at AMD right now, let's just go down the list. And you take a look at AMD. I always like to start out with my process. Start with the monthly, you take a look, back check it, and even on some of these, the quarterly. And what I do is I look at, okay, what's the overall progression here? I have a few lines of kind of support, resistance. What has it done? What's the stock been doing? So that's kind of what I watch. And when we're getting into AMD right here, the key line that I'm watching right there, as far as the longer term, and you look at the quarterly, is that level right here. That'll put us at around $16. Okay, so as I go into the monthly, does the monthly confirm that? And you can see as I back check it, again, it's not going to be perfect, but as I back check it, you could see I have a couple of levels right here, and that'll put me around that 16 range as well. So I'm looking at 16. So as we get into right here, 1550 on the daily. So if this stock was, if I was in this stock, or my brother was in this stock, if it got into the 1545 level, I would say take half off or take most of it off. And the more value range, depending on how long you hold things, around the $10 range, right? So you want to see that level. If you're a little bit more active trader, you could say 1185, 1190 could be a value buy, and that's only because of here. This level, this range, but the reality is the 10 and 15.50, $16 is kind of the range. So that's what I would look at to sell at, would be about 15.50 if possible. If I was in it already and I started to see weakness, then I'd probably take half off, depending on which price I was in. If I'm looking at shop and I'm looking to get into shop, I wouldn't get into shop with stocks actually. And the reason I wouldn't get into shop with stocks is because it's stretched. The way that I would play shop is through the options. And I would probably do something like, I could do, well, right now, if we look at things right now, you want to look at the VIX. And the VIX is relatively even. So if we look at kind of this range, that means option prices are neither high nor low relative to the last few months. They're kind of right in the middle. But are they trending lower or are they trending higher? Well, it depends how you look at it. You get two traders to look at technical analysis. They have different perspectives, right? My perspective, I look at my way and I set a plan or trade. So I could say, well, I could put on a calendar on this, or I could do a vertical on this, or that kind of thing. But I'm looking for a directional trade when I'm looking at shop, simply because it's stretched. So if I was to do a calendar, I'd kind of put it right in the middle, and my calendar range would be kind of spread right there. If I was to do a vertical, I would go ahead and sell kind of a vertical, depending on the option prices, somewhere around that $90 range. If they have options, I don't even know. Let's take a quick look. Shop, yes, they do. So I'd probably go about 40 days, 60 days out maybe. They don't have the 60, so I'd go 135 or the 44. Either one, the 135 days, that's days until the last trading day, or 44 days. And I would probably do something around the $90 range. That way, if it pulls back to 90, I'm still okay. So I'd probably sell that premium or the calendar. You could do synthetic trades with this as well. Synthetics are really interesting, but they're very advanced. So the way that you could do it is, let me see if I could show you here. You basically do a put and a call, and you could do it like this. Basically, it mimics the stock, but this is way beyond our current webinar, actually. So this is a fairly advanced stuff. You synthetically manipulate to get a stock, but use less capital. You use it through options. So I would do it this way. So you could see you don't have theta decay. Anyway, that's beyond the scope of this video, but that's how I would do it. And let's take a look. What's your favorite stocks to swing trade lately, and why? I would say it's the big companies, and that's just because I know them. They have options. I mean, you take a pick. It doesn't matter. It depends which one's moving at the time. It'll be anything, and I'll pull out my list of favorites right here. And these change. Usually, I'll just sort by price, honestly. Anything like Amazon, Google, Tesla, Baidu, CMG, more to the short side, Facebook, Netflix, these are the big boy companies, Adobe sometimes, Win, Buffalo Wild Wings, Autodesk, those are probably the main ones. And anything else that really pops up, but you know, I like trading those because I know the clear lines. They make clean patterns. So if you look at Amazon, it's very clean to see things like our ABCD patterns. Let me get my zoom tool here and get that set up for you. So when you look at this, the ABCD patterns, A to B, B to C, C to D, and then this actually continues to do the same thing, A to B, B to C, C to D. So anyways, I like clean patterns. And let's see here. What do you think about cryptocurrencies? What might be their future? I'm not really sure about cryptocurrencies. I have to tell you the truth. Let's see here. Why is this output external? Output. There we go. More live again. Cryptocurrencies, I'm not 100% sure about, simply because they can be manipulated. There's a lot of hype behind it. I always think back to how risky do you want to get? I mean, if you got into them a lot earlier and a lot sooner when it comes to cryptocurrencies, in that case, I would say, by all means, ride it, take half off, take a third off. But if you're just trying to get into cryptocurrencies now, to me, it's similar to getting into stocks when it was, call it year 2005, 2006, 2007. You don't know if you're in year 2005, 2006, or 2007 when it comes to cryptocurrencies. I have no idea about that. But if you're in somewhere around this range or this region, there's going to be massive pullbacks. And if you look at cryptocurrencies in general, there's some serious huge pullbacks with cryptocurrencies. And let me take a look here real quickly. I think it's called World Currencies Exchange. There's so many of them. Cryptocurrencies. Let me see if I could find it here. I just talked about this actually not too long ago, and one of my, you could say, Facebook people asked about it, and actually my accountant, and because she had somebody doing some cryptocurrencies related to things, and did some interaction there. But basically, it's not something I would want to get into. It's a little way beyond the scope of what you want to trade, simply because the risks that are involved with it, it's just, just too complicated. In either case, I don't remember where the link is where I posted it, but let me see here. One more second. I'm just going to take a quick peek. Here it is. I got it. Okay, let's take a look at the World Coin Index right here. I mean, you got Bitcoin, Litecoin, I mean, all these different coins. And I mean, you could create your own cryptocurrency and then have people buy into it. But, you know, the fluctuation here that you have, sometimes they're up 100%, down 25%. It depends how much volatility you want. And in my case, I mean, if you're looking to invest consistently, if you want to invest consistently and you want to go ahead and how do you phrase it? If you want to go ahead and make consistent returns, it's much better to stay to something that's more consistent or regulated. So in either case, that's what I would recommend. Anyway, that's just my own thought. Okay, so let's take a look here. Another one, LGND and CYRX. If you have a ticker symbol, please go ahead and post it on the Q&A ask a question section, simply because I don't look at the chat as much. Okay, so here, CYRX. This is a cheap stock. It's overextended. I would rather look to short it coming up soon rather than buy into it. That's how I would trade it. Mostly stocks that are cheap, they're cheap for a reason. And I would look to see when the weakness comes in to short it, because the overall trend of it is down. There is a lot of volume that comes in, so I mean, it could run like this for a couple months or even a couple years, but I'm just too cautious to trade stocks like this that break out from a $2 range in a year to $9 or $10. The majority of them, I will say, go lower. There are a few that go higher and stay higher, but the majority of them stay lower. Let's see, what else do we have here? Okay, CYRX. We went ahead and did that one. And did that one. Okay, Priceline and Ulta. Let's just do a few of these. Priceline, I posted this one in the critical charts. 1800 is the key level. With stocks that are really big, you always have to give them a lot of wiggle room. So when you have a stock like at $1,800, there's a thing called confluence, just like I mentioned with your friend showing up 615, you know, it could be 620. Here with these stocks, you got to give them more wiggle room, and you can see this stock dipped below that $1,800 level. So even though we had 1,800 at this price point, and basically at these price points, but it dipped here. But when you look at this, you can see that this price point actually dipped down to 1,774-ish, give or take a point or two. And that's about 30 points, 25 points or so from 1,800. So you got to give it at least a good 50-point stop on stocks like these. When I look at Priceline, I definitely would rather trade this one a little bit on the option side because it has options. But look for opportunity on how far stretched it gets. The volume right now looks okay. It's not too negative, but market is acting a little bit sluggish this last week or two. So be a little more cautious unless we break out to the upside beyond that S&P higher level that I talked about. So here what I would do is look for extensions. You could use a simple indicator like a Bollinger Band, and if you take a look at weekly, you can see we're kind of in a little lower range, which is okay. If you look at the daily, you can see how this daily is tough to read on big stocks, so that's why you look at the weekly. So you can see here we're kind of at near the lower range, and this just shows you two standard deviation moves on that on relative to the recent volatility. So this brings me actually into a let's go into some questions. This gets into the indicators. So the question here is, let me see if I could pull it over here on this screen. There we go, without too much video problems. Some traders obsess over finding obscure technical indicators. They're magic bullet, if you will, but aren't indicators, only useful because multiple generations of traders have perpetuated certain conventions? Or do indicators have objective significance quite apart from the group psychology? In other words, the most commonly used indicators should be the most useful ones, right? Yes and no. Useful is depending on you. Useful, is a pen useful in situations when you need to do some coloring in a coloring book? It's not as useful. It can be helpful, but it's not as useful. So useful depending on your strategy. I always started to, when I got into technical indicators and all these technical analysis and looking at things, I always was looking for, what do other people use? What does Sasha put on his chart? Why does he use Bollinger Bands? I would always try to match myself with somebody else because I always thought they knew better. In the end, when I got rid of all those things and just simplified it to price, action, volume, and behavior, and maybe one or two indicators, it really simplified my life and it made trading a lot easier. Didn't complicate things. So for you, if you're looking for kind of an indicator, yeah, the most common ones like a moving average is good to have on screen. When you're looking at like a 20-day, 50-day, those kinds of things, they're nice and handy because a lot of traders watch them. And as they, let me see if I could find a stock, as they break above them, or prices normally gravitate towards them. So you can see here on Netflix, there's kind of a gravitation towards that 50-day moving average. But in general, what you need to do is really focus on price. The market, the price is the key. That's the dominant factor. And then beyond that, you have volume that confirms the move, and then the behavior, how's the stock behaving? So all these things actually give you a lot of insight to the overall progression. The indicators help you see that and confirm your analysis, or give you another perspective to double check things. But can you get the Bollinger Bands simply from looking at this moving average? Can I do that? Yeah, absolutely, because I know price is overextended there. So if I look right here on the Bollinger Band right now, I know that's going to be at the higher end. And you can see right there, boom, there it is. It's very simple. If you just have the moving average and you learn about price behavior, that's overextended. This is not fully overextended. If it was down here, it'd be more extended. And it just goes with time. So anyway, I hope that answers that question. You could use more common indicators, but don't make your life more complicated. One or two is all you really need or want. You don't want to complicate your life. For me personally, moving average, price and volume. This is how I look at my charts. From time to time, I will check Bollinger Bands right here, simply to see how far extended are we? Are we really way above it? Like when a move is just explosive one way or the other, I'm like, how far stretched are we? I'll check that. I'll check the VIX because it's all relative to the VIX. I'll also check the McClellan oscillator here. Let me see if I can type it. I always mistype it. McClellan oscillator right here. Let's see if it'll pull up. Yeah, there you go. So I'll also check this. This also tells you overbought or oversold conditions. And you can see we're a little bit overbought on this McClellan oscillator. So, but again, that's just an oscillator. It doesn't mean much. You can be overbought for quite a long time. But that's just, another one I peek at. But really, you can get a lot of things from price, action, and volume. It just means keep it simple. It just means if you aren't getting things from price, volume, behavior, you're just either overcomplicating things, you're unsure about yourself, or you haven't learned how to read the price, the volume, and the behavior of stocks yet. You don't know how they breathe, right? With a human, you know how you breathe, right? It's just nice, normal breath in and out, right? When you're running, it's going to be... It might be something like that. So the breath, the pace is different. And I bet if you just close your eyes and you heard different types of breath, that could be either a dog panting, it could be somebody running, if somebody's, they're grunting, you probably lifting weights, the behavior, right? You don't need to see it, you know it. So anyways, hope that makes sense. And you do the same thing with stocks. Let's take a look at some other questions. When you start trading, how long did you trade stocks before you tackled trading with options? I'd say I stuck around with stocks a couple years, maybe 3 years, 4 years. But I started learning options, I would say probably my third year in. I can't remember exactly because things start to overlap with time like that. So you start to look and learn about options. You might visit it. Oh, this is interesting. You start, fine tuning some things with options. You're like, oh, this stock has options. Then maybe you place a little trade with options. And then it doesn't work out. Then you go a little more and you just keep learning upon it. And then you use them just like you would. Hey, sometimes I need a pen to teach a lesson. Sometimes I need a Sharpie when I do this. Other times I need, as you've seen me on some of those glass boards, I need kind of a neon marker. This is a highlighter, but sometimes you need different tools for the job. So depending on market conditions, having different tools allow you to be more flexible. Can I use a highlighter on the glass board? Absolutely, but it won't be as effective and it won't be as good looking, right? It won't be as crisp. Can I use a Sharpie? Yeah, I could, but again, it's a pain to clean it. So you have these specific tools because the conditions are set up in that way, and it makes things better. Can you still trade only stocks? Yes, you can, but the more tools you have in your toolbox, the better you can fit the peg in the hole, or kind of thing, or better you can coordinate things together. All right, let's take a look on a couple of things. Do you know any trusted discount brokers in Canada? If you're familiar with, what do you think about Questrade? I don't know much about Questrade or Canadian brokers. I visited Canada a while. I've done some research. TD Ameritrade has TD Waterhouse. So if you want the Thinkorswim platform, I know you need TD Waterhouse. The other thing is, I actually did the foreign account lesson here on the Let's Talk Stocks lesson about a week or two ago. And that one has a couple of notes and insights actually about Canadian brokers. So if you go to the TRADERSFLY website and you go to the blog, the all posts, by the way, the website we're working on more things for websites and that kind of thing. And you just go to search for a foreign account, and you can see here how to trade in a foreign account. There's a couple of notes here that talk about Canadian brokers in there. So take a look at that when you have a moment. Interactive Brokers, also another broker. But you can actually, a handful of brokers that do business within Canada will allow you to trade in Canada. It's just a matter of filling out the appropriate paperwork. Unfortunately, things like Tastyworks right here, they do not. They don't let you do things. Let me see if I could find it here off screen. There's some regulations that go with certain countries. Let me see if I could find it here. If you look at it, so here, these are the countries they're looking to expand on, but unfortunately, due to restrictions, cannot residing in Canada or Australia. So they have their own rules and regulations, and certain brokers, it's harder to get, I guess, requirements set up in certain countries. And I know Canada and Australia is a little bit tougher on that. But some other countries will be available with Tastyworks, and that goes the same with other brokers. So if they have a thing in Canada, then they're good, or they've got the paperwork. Anyway, I hope that helps. I'm not an expert on it, but maybe somebody else can chime in. Do you think Forex trading is riskier than stocks? I don't think Forex trading is riskier than trading stocks. I'm not an expert in Forex trading. I think I've put on one Forex trade ever, to tell you the truth. But the thing about Forex is Forex, when it comes to trading and when you look at investing, you make money in trading through volatility, right? You need movement. Anybody who says you want a crushed VIX or they want the VIX to go lower is a person usually that does not understand trading or investing, or doesn't understand how money is made in the market. It's through movement and fluctuations. The higher the VIX as an active trader, the more opportunity you have. That also means the more movement. So that's your breath. That's your air as a trader. You need the VIX to be higher, and you need movement in the market, so that creates opportunity. As stocks drop, you buy it at a lower price, then they spike up and you sell it, and you do that rotation more frequently. So in either case, so when it comes to Forex, the reason people like Forex is because of the leverage factor. When it comes to stocks, you get the margin account or portfolio margining. But when it comes to Forex, they give you like 50 to 1 or 100 to 1 or 500 to 1 leverage to use because the movement is small. So you need that extra leverage to be able to make more money because the volatility is smaller, because there's no blood in there. Not to mention also currency trading, you're intermixing with two different animals, and it's not something that I really kind of like because anyways, two countries. I would rather buy, like, let's say $30,000 worth of, let's say, the euro and just kind of keep it and hold it rather than doing the trading. Anyway, that's beside the point, but it's not my thing. It's not my expertise. Is it riskier? Risk just depends how much you put on the table and what your experience is as far as that's concerned. Let's take a look at it, one or two more. How many years did it take you to master options? I wouldn't say I mastered them yet. I always try to be a little more humble about the whole thing, about even in trading, I don't know everything. But I'd say where I was really comfortable with options, I'd say probably 4 to 5 years, because there's a lot to learn. I wanted to first jump into iron condors. That was the main thing. Then I wanted to, the first thing actually was really buying calls and buying puts. That's the rookie classic mistake. Then I got into iron condors. Then I got to calendars. Then I moved into butterflies, and then I got into diagonals. And recently I've learned about more synthetic trades and got into gamma scalping and theta scalping. So there's always more I'm learning, but I find that you don't have to get too complicated to really do well with options. You can keep it really simple as well. I'd say verticals is the core foundation that you always want to learn, and iron condors are the base because it's the base of selling. But in certain situations, calendars and diagonals are also very useful. And that all ties to iron condors as well. So you want to have multiple strategies usually put on, and then that way you can minimize your vega risk and exposure, because you need to learn how to cut your vega risk, especially when it comes to options, because there's no vega when it comes to trading stock. And that's one of the things people have problems with, and it's what I had to struggle with. So, 3 to 4 years, maybe 5 years, depends what you study, what you learn. I'm trying to get more insight on my courses and get those knocked out here over this next couple months, and hopefully we'll get more of the option series complete, and that should be a good foundation to get you started and to learn a lot. Let's take a couple of other ticker symbols here real quick. Okay, what is your opinion about low beta stocks such as, let's bring this back, such as AGN or AEE with linear movements? Do you think that swing trading them is a good strategy to start with, times 10 leverage or RR ratio of 1 to 2? Any suggestions from Italy? Okay, so looking at this one, I don't really look at beta per se. I just look at how violently the stock moves. So it's not that I know that Apple is a beta of 1 point whatever or more or less. Some people like to use it. I look at price movement. I look at the volatility. That's the way I do it. I teach about beta. I know about beta. I know how it works. Do I look at which stock has a certain beta of what? No, I don't. I will just type in a ticker symbol of something like AGN, and I'll take a look at how big are the largest bars. So let me look at some of these bars. How big are they, whether they're to the upside or to the downside? How far stretched does a stock get from a moving average? So if I look at it kind of like this as well, that's kind of our volatility, and that's what I look at. Swing trading them is like trading any other stock. So I'm looking at how clean is the price pattern. So again, I'll start with a monthly. How clean is the price pattern? What am I looking at? And here I'll start evaluating things like retracements, right? So as I'm looking at kind of retracements, how do they line up? And you can see here, this kind of lines up to the 50% level almost exactly from our earlier breakout point. And then do we have a counter bounce, and will it come back here? Those are things I look at. How's the volume? Do we have a couple of bearish spikes? Is the volume kind of decreasing there? So all these things you kind of take into account, and you just trade them like any other stock. Do I care if they're low volatility, high volatility stocks? No, I don't. Or low beta, high beta stocks? No, I don't. I care just about the price movement. I mean, as I mentioned earlier, it all comes down to price. It's all about the price. That's what it comes down to. Again, how would you swing trade them? Well, when you look at this range, depending on if you're short term, 220 could be your area. But if we have bearish volume coming in, do I want to wait for a bounce here, or do I want to see it break through lower and short it, and then come down to 188? So again, you're looking at the ranges, you're evaluating the charts, and you're putting your risk on the table. And hey, if it's moving against you, boom, you're out. It's that simple. Depending on the stock, obviously sometimes it's better for options depending on what it's doing and if there's options. Let's take a look at AEE as well here. But the same kind of thing. You look at overall, how's the stock behaving? So you take it out monthly. You take a look. You see, are we stretched? This one, yeah, we're a little bit stretched. Not too bad, but we're a little bit stretched. Then you go into the weekly. You start looking at where some key levels. How long do I want to hold the stock? Do I want to just kind of buy on the dip over here and see if it catches and bounces? Do I really want to get in it? And see, is volume acting the same well with the stock, and you start combining these things. So if it comes by and bounces and volume picks up, that's great. But you really make the decision at the time, because you're looking at this and you're saying, well, how's the volume behaving? That's ultimately the key. It's one of the reasons, actually, as I looked at SPY right here, and a few people messaged me on the live chat and things like that on this big down day. And I told them, and also if you look at the critical charts, the volume on the pickup here was a lot lighter. Okay, so when we look at this movement, it was acting sluggish. And if you look on that volume bar as well, this one, very sluggish. And that created our second point. Now, I didn't know it was going to be the second point at that time. I just knew the volume was weak. And that's just learning about behavior. So I had no idea that would be our second point. But when it became our second point, now I had opportunity to create a third point. Now that, again, you're looking at the volume here and you're seeing, okay, is volume weak or is it strong? And here we're actually picking up a little bit of volume. Right there you can see it's picking up. I can't draw that low. There's an issue with the drawing program. But right there it's picking up just a little bit. Let me use just the regular line. So here you can see that right there the volume is accelerating, so that picked it up. But then again, we're dying out at the upper level. So it's just learning about the behavior. Okay, let's take a look at a couple other questions here. Do market makers, let's see if we can cover this question. Do market makers purposefully configure their algorithms to incrementally move a stock's price to specific levels that they themselves predetermine, or are these nearly perfect angles, perhaps as a form of groupthink? Okay, so looking at technical analysis overall is based on human psychology. It's price behavior, how far things are stretched, people taking profits. So a lot of this is psychology, group behavior. But that's why sometimes they can go much further to the upside than you think, and also much lower to the upside or lower to the downside than you think as well. So in this case and in this situation, technical analysis, it does, when you look at patterns, it does coincide with, like, let's take a look at Netflix or Win. I mean, you take any kind of stock in general, they do confine to group think and group mentality. So if I look at it here, you can see this is a classic A to B, B to C, C to D pattern. So your movement from C to D should be about the same as A to B over here, right? So if we do the measurement from this lower point to the upper point, about 142 points, and then we go here to here, you can see about 160 points. Not perfect, right? But right around the same region. So again, stretched and creates the pattern. So the thing with market makers, they, depending on their size of position, they usually try to get out when this euphoria starts to kick in. So you see these 3 bars right here. Usually they may start that first bar, not always the case, but they may start this final euphoria stage, this last bar, their last leg. They'll buy a quick, normally here at this digestion period or somewhere here, they were buying lightly, right? They're trying to buy lightly because otherwise they move the stock. If they buy like 10 million shares in a day, they move the stock. So they buy lightly in this range, and then here they might buy in a couple days or more compressed time frame. Boom, their last final buy, and they play a psychology game. It could be, not always the case, it could be, but this is what I would do. They play a psychology game to, boom, drive the price a little bit higher, gets people more excited, a lot of the new traders. And then what they start doing is, as new traders start coming in, they start selling. That's when they start dumping a lot of things, and that's why you get the distribution right here. And then finally, they start taking it lower, and then they, boom, dump the remaining shares that they got in over at that level. So you can see they're still way above that level. So that's the way it kind of works on a simplified version. I hope it makes a little bit more sense. So when you talk about, though, also manipulation within like a 5 or 10 point range, or let's say 1 or 2% range, they do move things for, they call it pinning, and they pin it based on option contracts. So if you take a look at WIN here, since we're talking about WIN, we have 9 days till the standard option expiration goes through. And when we go to, let's see here, the open interest, there's a lot of open interest here at the 142 level and 145 level. So depending on where the volume is on the option side, like let's say a hedge fund has 1,000 or 2,000 contracts around this range. They wouldn't just have it at 145. They may have 100 at 144. They may have 100 or 500 at 145, another 200 at 146. So if they need those option contracts to be more valuable, they will pump up the price a bit and to make sure that contract is more valuable because they can move the stock. So that's how they do it. Why wouldn't they roll it up? It gets too expensive. They may want to buy the stock. So that's why they pin it. That's why at the end of the option expirations, they have triple witching. Everything just coincides on the position. And they have so much money that sometimes to roll things up, then they need to buy a lot in one day. Whereas instead, to move the stock, you just buy the stock in one day or sell the stock in one day, right? So you short it. Whereas with option contracts, you have 1, 2, 3, it could be 5 or 10 different strike prices, and then you have to get in it. Otherwise, you risk theta, you risk the movement of the price of the stock. When you're trading larger, that's kind of what happens. Okay, let's get into going through these fairly quickly, but there's a lot of questions still. We have a ton of questions here. So let's do, what do you know about the different seasons of the year and times of the month affect the stock market as a whole? What specific patterns do you see that a trader should take into account? Always the seasons of the year, the best trading times actually is after here, September 1st, September 5th. Usually tends to become a little bit better. Not always the September month, but October tends to be more active. And if you actually go take a look at stock market crashes, which we talked about in the past, the stock market crash of 1929 was in October 24th. If you take a look at other crashes in the 80s, a lot of them coincided around that October time. So, Black Monday as well. Let's take a look here at Black Monday. Here was 87, October 19th. So this is when a lot of traders get back in. There's a lot of psychology that's involved around that because people are back in their work thing. So your mind as you get into mid-September starts thinking about what's the next stage, my job, my this, the holidays. And that's why October till November, Usually Thanksgiving, November, December, January, February are the biggest trading kind of months, a little more active with the exception of those couple weeks in December. I would say when you have more holidays, though, be careful with the volatility. There's usually more movement in the stock market, but that's why they're the better trading times. Remember what we've talked about, the volatility. Volatility is great. Sell-offs are great because they create opportunity. A lot of new traders don't like it, though, because it's not moving in one direction all the time. But as you become more experienced, that's actually what you want. You want the dips to be able to buy those dips or to be able to short things as things pop higher. That's kind of what you want. So that's what you want to be aware of, is just that things usually get a little more volatile, and sometimes you get those surprise days where they're much larger than the previous months. So always be prepared for that. Let's go back to some charts. Could you take a look at AVH, please? AVH. Okay, so here again, stock is, okay, it's very lightly traded, so be very careful on this one. It's only 133,000 shares. So 133,000, let's just get a calculator out real quick. So when you look at this one, if you get 133,000 shares, just wanted to show you the calculator, times $8 a share, with just $1 million, you can move that stock. That's not a lot of money in the marketplace. So be very careful. You want liquidity in the stock market. So here, if you're trading this, I wouldn't trade more than 1,000 or 2,000 shares. Be very careful. Overall, when you take a look at the monthly, stock is lower, right? The trend is down. The recent trend, as you can see, is to the upside. The question you might be wondering is this creating kind of an A to B to C to D pattern? Could it be? Maybe. Be careful with the volume down below, right there. That could be a little bit more bearish. And now as we're heading higher, you can see the volume under that is bullish, but it's too light. It's so light. There's barely any volume on the bounces. Take a look. Here we have what's the volume here? 3.64 million on the monthly, and then we got 1.8 million on the monthly. And to the downside, you got 3.7 million, 4.6 million, 6.3 million. Even this big bar was 6.1 million. Here we had 6.3 million. So that big bar, but it sold off. It wasn't able to hold, too far stretch. So anyway, be careful. Otherwise, if you're looking for, let's say, a weekly right here, I mean, for a short-term trade, let me rephrase that. I don't like using short and long within regular verbiage. For a smaller time frame trade, you could trade it, but I would look to get out of it by the time it hits the $10 range, simply because there's some more trouble there. If you're looking for a long, if you're looking for a short trade, I would watch kind of the 740 range or even somewhere around the 630 range. So that's what I would do. Let's see here. Let's take a newer question here. I am new in, I'm going to guess that's trading, and start with, what is ST? With ST at here, and training, and what I have to do. What else? I'm going to assume ST stock twits, maybe. I would say check the getting started page on the TRADERSFLY website. That'll get you started. So when you go here, go to the start here page, watch the videos. It'll get you started. There's some books you should read. You can take a look at the full list as well. Recommended reading. Not all of these are my books. I just think you should read these books if you want to be a trader, or you want to be an investor, you want to trade some stocks. It's not going to take a lot of time. Put some time into it. Learn these things. Do you have to read all of them? No, but the more you know, the better off you'll be, obviously. Okay. So let's go take a look at another one. Okay, could you explain how a stock like Fizz can be so powerful on decreasing volume on daily since 3 months and with almost no pullback since a year? or more. The monthly chart of that stock is amazing. It's never time to jump, but in the end, it's always time because it goes up every day. Okay, so let's take a look at this. I'm not sure which one you're talking about. National Beverage Corp. Okay, so the way this moves, how it can be so powerful on decreasing volume, is because there's barely any volume. So it doesn't take a lot to move the stock. Again, a stock that's trading only 180,000 shares on average is not a lot of volume. So that's why these stocks can run up really high, really fast. It's kind of like the Ferrari company as well. It didn't used to trade as much. So 400,000 is still not a lot in the marketplace. So you can see back here about 500,000. So you can see this one ran up quite a bit. Ticker symbol RACE. So when you don't have huge volume, this one now is starting to pick up, but Fizz is not a lot of volume. So when you look at this right here, you can see that on the monthly, they got a lot of stock splits here, which is a little bit of concern. 4-to-1, 2-to-1, 2-to-1, 6-to-5. A little bit of a concern. And then as you get into it, yeah, it's doing well, but I wonder, you know, again, it's like Nvidia. Can you get in it? Yeah, you can, but how far stretched are you? How much more do you have to go? You never know. They can go to 150, but then sell off. So how can, if you're asked for how can it do it like this, emotions, emotional buying, euphoria, that's just what happens. The volume is there at the moment. Looking at it, if you look at the weekly, the volume is still there slightly, but it is decreasing on the weekly now. So when you look at the monthly volume actually is huge. So it's been moving up on volume. So there is volume. It's just that the amount traded is not a lot. So relative to the stock, there's still volume that fuels it. But overall, compared to the overall regular stocks, it's not a ton of volume traded on the shares. So here you're looking at 8.7 million on a, what is that, monthly? And when you look at Facebook, on a daily, you get that. In one day, you get 13 million, twice that. So it takes 2 months of this stock to just trade one Facebook, right? So anyways, relative to the stock, it is trading with good volume, but there's not a lot of volume. And with that in mind, that also means when a pullback happens, it can get nasty because there's not a lot of people in it. So be careful. So anyways, the way that it does it is because it doesn't trade a lot of shares. These spurs can last for a while, but then since you're so far stretched, when the pullback happens, it can get nasty. So be careful. That's my point on that one. Okay, let's take a look at this one. Hope you will speak some on the political unrest that affects the market. Debt ceiling, government shutdown. Anyway, it comes down, politics is an interesting thing. It didn't used to affect the markets too much. I think it's affecting it a little bit more now, and it does it periodically only because people get unsure. The markets will believe anything any leader or president really states. It's gullible. That is because of the hope factor. So even if Trump goes out and purely lies and everybody knows he's lying, and or like the healthcare reform, oh yeah, we're gonna pass it. We'll pass it. We've passed it already last month. Even if they go out and they say they're gonna pass it, and the chance of passing it, right? Okay, maybe it could have gotten passed. The chance of passing it is, let's say, 5%, and that's what was the initially budgeted in. Let's say you had a 5% chance of passing it, let's say 6 months ago. The market will believe it much more so, simply because not a lot has happened yet. And they want to do that because if it does get passed, then it'll continue going higher, right? And if it doesn't get passed, well, then you sell off and you take half profits and so on. So it doesn't matter. The people of the hedge funds, they'll buy into anything. Tax reform, oh, great. Tax cuts for the rich, fine, perfect. Doesn't matter if the little guy gets hurt or this or that. In America, sad to say, a lot of people don't care about you in the sense of the economic standpoint. And that is to say, because it's about consumerism. That's what America was founded on. So a lot of it has to do about working, making money, things, and pro-business, right? So economics right here. So for me, I always try to help out and contribute, but I actually wish they raised taxes, because then if they raise taxes, rather than lowering taxes, if they raise taxes and the government took care of all the charities and things like that, then, well, hey, I'll pay 10% more taxes, and then you don't have to go and personally find a charity to donate to. Donate to this charity, donate to this school. This school is, I'd rather just pay more taxes and let the government take care of it. But with that being said, looking at the markets, political unrest will happen, and sometimes it affects it more so than others. I would say, just be careful with more volatility. As things grow like a fireball, the more likely you'll have snapbacks, and those actually become opportunities. So America should survive and move forward, I would think, and so will the rest of the world. It's just the market has panic movements, and when you look at the overall big picture of the market and you just bring things back, I mean, it's climbed since the 70s, and you've had some pullbacks, so be aware you might get another 2-year downturn right here. Who knows? 1 year could take it back to 1500. It could take it back to 2000. It's only 400 points, not too bad. And then things can continue climbing higher. So anyways, just be mindful. That's all. With politics, whether it's a government shutdown and this and that, it just depends how the market reacts and behaves. It's kind of like the terrorist attacks or school shootings. When the Columbine thing happened, initially school shootings and things, people getting shot, were much more affected the markets from what I recall when I used to watch the markets during that time when they first started happening, all the shootings. And then later with time, that kind of people became more accepting of it. Oh, it's just another shooting. We become more numb to it. It's sad to say, but that's just the way things work, unfortunately, within the marketplace. Anyways, let's take a look. A couple more questions. We're already at an hour in, and I think they only give me an hour and a half on the webinar. So going on to a couple more questions. How are you personally continuing to grow and develop as a trader? For example, are there specific topics, traders, authors that you're seeking to learn about or from? And what are they? Are there any trading strategies that you're exploring and experimenting with are new to you? Have you ever sought out personal mentors? A lot of questions in there. I'll just give you some insight to me personally of, I'm an educational nuthead. I used to be all about studying, reading, courses, seminars. I would say I did that for a good 10 years, 14 years, even while I was trading. And I still do a lot of books and things, anything I can get my hands on. So I always like to learn. Education is kind of the fire in me, and it's one of the reasons why I like teaching as well. So usually when you first start out with any subject matter, it doesn't matter what it is. It could be photography, digital design. A lot of times initially you want to get things in. Take photography, for example. So you want to read a book, you want to learn about the camera, all those kinds of things. As you become better and more proficient at it, more professional at it, you want to get things out. Okay, so initially you're getting things in, later you want to get things out. So as you get things out, it's about taking pictures and posting those pictures when it comes to photography. If you're doing videos, same thing. First you're learning about videography, then you want to get things out. So with trading, at the beginning there was always a lot of things I wanted to get in, and now the higher level for me is actually to get it out of my head and kind of make a mark of, okay, this is what I've done, and getting it out actually helps make sure that you're specific about your subject matter, that you're very detailed. So is there more to learn? I think there's always more to learn. Is there more to improve? There's always more to improve. But what fuels your fire? How much more do you really want to learn? How much better do you want to get? There's always going to be better people than I am. There's always going to be better traders, more successful traders. It's just about for what fulfills you personally and how much money is enough for you when it comes to trading. You reach a certain level where you say, hey, this is enough. I feel good with these strategies, with this consistency. and I'll keep doing them, and I'll move on to maybe the next purpose in my life, whether that's to get married, have kids, those kinds of things for you, you know. So it just depends where you're at personally. So anyways, so that's kind of, I hope, summarizes that question. Okay, let's take a look. I followed this video very seriously earlier. Okay, great. Is there any advantages to one markets in comparing with the others? Yeah, I mean, usually you look at the leaders. So the tech companies like the NASDAQ usually leads the market, and that's because it has bigger companies in there. For like the tech companies, it's more tech heavy, the composite. The S&P is 500 stocks, and then you got the Russell or the RUT, IWM. That's kind of the overall 2,000, 3,000 stocks. So usually they work together if you're looking for a market sell-off. But the composite is always much more important, I would say. But I like the S&P because it's got about a little more average of the, average stocks. So 500 stocks rather than the composite. That's a little more tech heavy. So anyways, which one you look up to it's up to you depending on which one you trade more often. The reason I like the composites, okay, that gives me more like a tech heavy view. And then I look at the S&P because I usually always trade a lot of option contracts with the S&P, and especially like retirement accounts and things like that. So that's kind of the way I look at things. But can you look at IWM or the Russell? Yeah, absolutely. So if you see like the Russell selling off or something like that, notice how we got into the 61.8 level and pulled back right away. So as you start looking at things and one is coming into a certain level, then you want to be careful because maybe the other ones will come back as well. So that's the way I look at it. Okay, let's see. We have a couple more questions here. I'll just try to conclude them real quickly and wrap it up here for you guys if you're short on time. Hope that you will also do a class or video on how to read a company's balance sheet or financial statements. Yeah, that's more business intensive. It's kind of on my list, but it's not a huge priority because I look at the technicals. The balance sheets, I look at it in the sense of, think about Enron, what happened with Enron. These companies can manipulate these balance sheets, and you have to also remember what companies do. A lot of times companies pre-ship things in advance. So take, for example, things like water bottles. I don't know if you probably can't see it because I'm on a green screen. But take, for example, digital timers or something like that. If you're selling digital timers to a store, you might say, hey, I'll go ahead and, every month I ship you 1,000 timers. But I need to sell more inventory this month to hit my revenue for my shareholders. So I'll sell you 1,500 timers this month, but I'll sell you the extra 500 at like 20% discount or 10% discount. So that way, when their financial earnings reports come out and the sales figures come out, what they do, these big companies, is they say, hey, Walmart bought an extra 500 units of our timers. We made an extra whatever amount of profit, even though it's orders that are fulfilled in advance. That's just the way things are. It's manipulated in a company. It's not illegal, but the balance sheets are a little interesting. Instead, the better approach would be to look at earnings per share and see if they break by 20% of the previous year. And 20%, because that 10% could be, and William O'Neill talks about this in his book, How to Make Money in Stocks. The reason, if it's only 5% or 10% that they break those earnings, then it could be that manipulation, or it could be they just laid off a bunch of people. Companies are always trying to fire people to call it productivity and reduce their workforce, especially the bigger companies. That's what they call it. So anyways, we may go over that. As far as order types, we have a video on this. When you look at any order type, there's you have a limit order here. Is the basic one. There's also a market order if you want to do a market order. There's a stop limit, trail stop limit, MOC. I don't even know what that is. I don't know what LOC is. I'd have to research it. I always use limit orders. Very rarely do I use market orders unless you're day trading, which you only do in volatile days, which have been good recently over the last week. In either case, then you also have advanced order types like blast all, first trigger sequence. So what you could do is when you have a first order trigger sequence, so what you could do is you could go ahead and stack orders. So you go ahead and put this order in. So when the first one gets filled, the next one goes in, and you can go ahead and set up additional orders like that. So, you know, the first one gets in, then the second, then the third. First order triggers the sequence. First triggers all, so it triggers all the orders to then go in. So you can stack these orders more complex, but that's beyond the scope of this video. You can contact your broker, and they'll go over these things with you. Okay, let's take a look at this one. I know that it can be different for each trade, but on a stop order, do you recommend to check the permit the execution on a pre or after market? And the pre hours can be more volatile, and the risk to be stopped out for nothing is there. The after or pre-market is also the place where the sell-off began. I'm not sure I fully understand the question. Let me recommend to permit the execution of pre. I don't understand the question, so I can't answer that one confidently. If you could rephrase that, that'd be a little bit better. Or simplify it. And let's do this last question here, and then we'll call it kind of an evening. Going beyond your experiences, the curse of the 16s, and your realization of how crucial volume is, have you had any other especially eye-opening experience or major epiphanies relating to the stock market that have shaped your approach to trading? If so, what are they? And thank you. Yeah, I had some serious issues when I was 16. I made a I would say boatload of money when I was young. It wasn't by luck. It was through my web design business, my photography business. So relative to that age, it was a good amount of money. I put that in investing, and I had some key losses there when I was young, trading in my mom's account, obviously, at the time with my money and my funds. And then, yeah, there was some major eye-opening experiences, I would say more so about trading options. When you get into options and you don't understand what you're doing, or you don't have a mentor, because I was young and there was not a lot of, we were still on dial-up at the time, obviously, so there's not a lot of videos, there's no YouTube at the time, not a lot of free content like that, a lot of it was paid content, so it was expensive on the learning side. So when I got into options, I struggled badly, and that's what made me work a lot more on personal growth and psychology. And I think the biggest eye-opener is that people don't invest in themselves, and they hesitate to invest in themselves, whether that's to buy books for yourself, whether that's to take time to stretch your hamstrings, for example. I have tight hamstrings. Whether that's to invest in personal coach if you need it, even just one time, you know, just to go in for like a checkup, like a physical therapy session, or like, you know, talking to someone. It doesn't even have to be me. It could be some other stock trader, that could be someone you met online. It's like all these people on StockTwits, you're tweeting. Why not exchange a phone number, do a direct message and say, hey, why don't we just chat about strategies? What do you do? What do I do? Why do you do what you do? You know, and that becomes a lot more valuable than it does just tweeting around and just kind of being where you're at. So push yourself a little bit better, a little bit more, look at things more into personal growth and psychology, because that's really where things start to come together. It's all about the outer game. The outer game is all this technical analysis, all this order entry, money management, but the inner game is all about how you react when things go against you, your emotions. If you can keep those pretty well, you'll have a lot of things together. Is there any change in your stance about your opinion from what you discussed in the political side of Democrats versus Republicans, Clinton versus Trump? No, actually, there's not. With Trump, actually, when I talked about that video, I assumed that we would have a market sell-off when he got elected, and we actually did on the future side. I would have expected a lot more of a sell-off, but I had to switch on my position very quickly on that. So when I saw the market buying in with heavy volume, and you can see the heavy volume right there by day 2, I flipped my stance. But I still think overall, whoever's in office, I still think relative for me, it doesn't matter who's in office, I still think we're stretched on the market perspective and we're due for a pullback. Whether that pullback comes in another year, 2 years, 5 years, I don't know, but I still think we're stretched. If we continue to have little digestion periods like this, and we do it again, I think we can go much higher if we continue with that process. The problem usually is when you go too much of a straight line. So if we get, a little digestion here, go a little higher, and another digestion, that's more healthy. But I still think we need a good flush. When it comes, I don't know. It'll hurt. You'll have to whip things around. You may not believe it, but yeah, you'll have to be quick to recognize it. And sometimes it's tough because the things have been doing the same thing for like 8 years. And last question. So a stop order can be executed or not during the pre-market or after-market if that box is checked. Otherwise, it will be executed only regular hours, even if it hits your stop price during the after hours. I don't know. This would be a broker question, something to ask your broker. I'm not 100% sure on that question, only because I always put on market orders during day trading, and then limit orders during the majority of the day, and limit orders when I do aftermarket. But it's rare that I actually do an aftermarket or pre-market order. Very, very rare. There's usually no need. Sometimes you can, but usually there's no need for me. I don't find I need to. So I don't know. You'll have to double check on that one. So if I don't know it, I'm going to mention to you that I don't know it. So I'd have to do some research on that and get back to you. I'm not an expert on all the panels and the rules and regulations. So anyways, other than that, this concludes our session. Hey, thank you so much for joining us. We've had a maxed out session for the amount of people that registered. I capped it at 75. I think 30 showed up. I'll have to bump that up later, maybe 200 people. And I'm going to check this video and see how I can improve it and do some tests. And we try to do one of these free webinars every single month. Not during maybe holiday seasons and summer vacations. I take a little break, but 10 months out of the year, try to answer some of your sessions, and I hope they're helpful, especially to those of you that have questions just starting out. It's kind of like a consultation, almost like a one-on-one, but with a group. So I hope it was helpful. Thank you so much. Truly appreciate it to everybody that came, to Jack, Michael. Let's put you guys in here. Jack, Michael, James, Gene, you're more than welcome. I do this for you guys. I do this because, I know how tough it is out there. It's sometimes the information can be confusing. As I always say, many of the things that I share are not new and revolutionary. I just try to explain them as best as possible so that you understand it. So thank you again for joining me. Enjoy the rest of the week ahead. This video will be posted on Thursday or tomorrow on a replay in higher definition. Make it a great one. Remember, more to life than money and trading. Once you get there, you got to do something more purposeful, and that's why I do what I do. So enjoy the week ahead. Make it a great one, and I'll see you next time. Thanks. Take care. Bye.